Dividend growth investing allows you to generate cash flow without selling your stock stake. The compounding effect is significant when dividends are reinvested back into your portfolio. Dividend investing can lead to financial independence over time. This is what we'll go through in this video. But first, we'd appreciate it if you could click the like and subscribe buttons. Now that's done, let's get the video started. Warren Buffett is considered the most significant investor of all time, and despite his age of 92, he has led Berkshire Hathaway since 1982. Buffett boosted the stock's value by 20.1% each year, double the 10.5% total annual return of the S&P 500 over the same period. It may seem minimal, but see until you understand long-term compounding. Every $1,000 put in Berkshire could have been $36,400,000, and $1,000 in the S&P 500 could have become $302 million. How does Buffett accomplish this? Warren Buffett's most significant advantage is his understanding of value investing. He knows that stocks are more than simply prices and charts. They're an ownership share in a business. When investing, you must think like a business owner. Buffett's success has come through long-term investments in companies with long-term competitive advantages and large economic moats that generate actual cash flow. Then after he does all that, Buffett reinvests revenues and dividends in profitable companies. That is what makes him a winner in this industry. Did you know that Berkshire Hathaway does not pay dividends despite their public stock portfolio producing over $1 billion in annual payments? They expect to receive 1 year's $6 billion in dividends. This in addition to operating income from companies like BNSF, Geico, Nebraska Furniture, etc. That is another way dividends have impacted Warren's growth. Stock market drops may make you feel disheartened about investing, but now is not the time to give up. Warren said that no one could refocus our community on basic investment concepts better than yourself. Warren Buffett is a value investor who buys stocks that are undervalued. It sounds simple, but it's not. Warren Buffett switched from trading quotes to investing in equities in quality companies. And as his famous analogy says, you utilize cigar butts to get rich. Ben Graham taught Warren quantitative buying. Warren Buffett said that he used to look for cigar bunch stocks and compared the cigar butt strategy to buying stocks. You see this awful sight while seeking cigar butts. Mushy cigar, you take it and get your one puff disgusting. You can toss it, but it's free. I mean, it's cheap. And then you go about for another soggy, puff cigarette. Well, that's what I did for years. Although we make money doing it, you can only make it with little money. It's so much easier just to buy beautiful businesses. Now I would buy a great business at a fair price rather than a fair one at an excellent price, he added. Time is the buddy of a great business because it keeps compounding and doing more business. Charlie Munger influenced Buffett to focus on business quality. The importance of quality was best learned through their investment in See's Candies. Warren said See's Candy taught them an excellent lesson, which will teach you a lesson too. He then said that they would have walked if See's Candy had asked for $100,000 more. One of the reasons we didn't leave was that we weren't willing to pay a dime more. Marshall said, "You're crazy. You should pay more for some goods and undervalue quality." And now, look at that business. It is way more significant than expected. Warren and Charlie listened to criticism and modified their ideas. Everyone should learn this, he said. Think of all the money we made from embracing that one criticism. And if you consider the indirect impacts of buying See's, you can claim Berkshire was established by learning from criticism. $2.83 million after-tax profits, and Buffett estimated See's Candy's labor capital needs at $8 million. He would only pay 10,000%, which was a mistake since See's Candies earned Berkshire Hathaway. During those years, Buffett more than tripled his initial investment in See's Candy every single year based on this. Buffett said See's had earned over $2 billion in pre-tax earnings, and the chocolate company is a cash cow for Berkshire Hathaway. Buffett likes See's Candies because of their brand recognition and consumer loyalty. Buffett says we seek long-term competitive advantage in a stable industry with substantial organic growth. Even without organic growth, such a business is rewarding. therefore will use lush income to buy similar businesses abroad as he did with See's Candy. Everyone should learn to buy great companies with a little growth potential but delivering stable cash flow. Buffett's future ventures would benefit from cheap oil. These candies are dividend stocks. Berkshire Hathaway owns them. He gives away almost all his revenues to start new firms. Candy has paid us practically all they've made because they can't use large amounts of money they earn intelligently in their business. Keeping money would be a tremendous mistake. So, they distributed Berkshire. He added that we hope to move it. So, it's worth $1.10 or $1.20 today. If See's Candy were a standalone firm, we'd send out earnings and dividends to Berkshire Hathaway. Warren Buffett doesn't target dividend stocks, yet most of his assets are. This is because he targets certain corporations. Dividend stocks are mature companies with proven business models. This overlaps Buffett's investment preferences. Berkshire Hathaway will earn $1 billion in dividends from its public stock portfolio next year, with only 5 holdings accounting for the full payment. Buffett's top dividend payer is new investment Chevron, ticker symbol CVX. His million shares corporate ownership Chevron distributes a quarterly dividend of 1.42 cents per share, or $5 annually. Buffett earns $1 million in dividends annually. Chevron will likely enhance its dividend payment in the coming months, enhancing future distributions. Chevron's dividend rose recently, and Chevron may soon pay Buffett's first billion-dollar dividend. Bank of America, or BAC, is the second largest dividend payer. He bought an average price of $14 per share and now owns over 1 million shares, giving him 12.9% of the company. Bank of America recently increased its quarterly dividend payment by 4.76%, increasing the forward-looking annual dividend to 88 cents per share. BAC paid Berkshire Hathaway $908.9 million over the next year, placing the dividend yield on cost at around 6.28% of its third largest payer. Occidental Petroleum, OXY ticker, has long been with Occidental, but in 2022, he made his biggest bet. Berkshire owns 188.36 million shares in the company, or 20.2%. Occidental reduced dividends during the oil collapse and is slowly reinstating them. The dividend is planned to pay Berkshire $1 million the following year, but this will expand. Berkshire owns $1 million in preferred stock and pays out $1 million in preferred dividends. This gives Occidental $1 million dividend income. Apple, or AAPL, is fourth. Buffett's Berkshire Hathaway holds more than 5.7% of Apple. He's already made a good profit, but this will be his following excellent dividend stock. He anticipates $1 million dividends this year. His cost base is $34.86 for each share, resulting in a 2.68 cost dividend yield. Apple has the world's most loyal customers. It has an extensive stock repurchase program and an increasing dividend. In 30 years, Buffett may double his initial investment through dividends, similar to his Coca-Cola stake, which ranks 6th. Buffett has KO since 1988. This is a good illustration of See's Candy-style long-term investing. With a cost base of 3.24 cents per share, he'll earn more than $704 million in dividends this year. Buffett's dividend yield is 54.2. This means dividends alone double his investment every 2 years. Coca Dividend Cola has been growing for years and shows no sign of stopping. This is an excellent example of long-term investing in a competitive company. These 5 equities account for over 71% of his $6 billion dividend income. Berkshire Hathaway owns many companies outright. Buffett reinvests dividends and own firm earnings to buy productive assets, powering Berkshire Hathaway's compounding machine. Reinvesting to increase future earnings is a great way to grow wealth. Berkshire Hathaway doesn't pay dividends since it reinvests money. That's a broader topic, and one that we'll discuss soon in another video. That's it for this video. If you learned something, hit that like button. And if you're new, subscribe to Stockologist. Don't forget to hit the notification bell. Thank you for watching, and we'll see you in our next video.